Good evening, ladies and gentlemen. Just going to wait for 30 seconds for everyone to join. Okay, I'll let it start. Good evening, everyone. My name is Akbar Patel. I'm an independent financial planner with BBT Group Limited. And normally, Charlotte from Teachers Retirement Agency would introduce us, advisors from BBT Group Limited, but she has got a home move, so she's unable to join this evening and introduce us. I'm going to give you a brief background about the BBT Group and the Teachers Retirement Agency. Then we'll talk about the modules that I'm going to go through today and for the rest of the week as well. In terms of the Teachers Retirement Agency, works with the BBT Group Limited, a chartered firm of the independent financial planners, and we've been doing the one-day seminars for planning for retirement for the last 25 years plus. But when COVID came through, we decided to take the key element of that one-day seminar and break it down to the 4 modules, which we would highly recommend you to view this in sequence where possible. Now, I'm joined by my colleague, Robert Wells, who will be going through the second part of the module today. We also offer a live Q&A session, which is private and only can be seen by us as an advisor. We have Carl and Gary, 2 of the advisors from BBT Group Limited. So if you have any question during the module, by all means, just use the chat function and ask them as many questions as possible. Keep them busy. For more technical question or a one-to-one consultation, we'll send you out a link at the end of this webinar. You can fill out that form, return to us, and we'll arrange a one-to-one consultation if you want as well. So let's get started. Here is a quick look at what we're going to cover. Module 1, understanding your pension. I'll cover the first half of the module, which is the basic of the financial planning, showing you how the state pension works, who is eligible for it, and how much you might receive it. During the second half, Bob has got really meaty stuff, which is going to talk about the teacher's pension scheme and its benefits. So stay tuned for that one. Tomorrow, module 2, we'll look at what happens if you want to retire early, how it will affect your pension, and the steps that you might need to take if you're thinking about retiring early. We'll also talk about what it means if you were to decide to return to the work after taking an early retirement as well. It's quite a popular session, so do join us tomorrow as well. On Wednesday, this session will focus on managing your pension income. So we'll talk about the budgeting, making your pension last throughout the retirement, and also using the tax-free lump sum for those lucky ones who are going to receive this from the final salary pension as well. So how to use those and secure your future while in your retirement as well. And the final one on a Thursday, module 4, will look at how to protect your money and the assets. This includes your keeping your pension safe, planning for your estate, things like the will, power of attorney, etc., and make sure your wealth is passed on to your loved one as smoothly as possible. Now, by joining all the 4 sessions, you will have a good understanding of your pension and how to plan for a comfortable retirement itself. Without further ado, let's get started. Before we begin, I want to kind of address a few important points to set the stage for our discussion. Risk warnings. We can't have a webinar without the risk warnings itself. So the information what we shared today and throughout the week is based on our understanding of the pension scheme, as well as the latest HMRC tax rules and regulations. The examples that we provide are accurate, but they are designed to be generic and may not directly apply for your individual circumstances. The objective of using this example is to illustrate the key concept and the principle in that way that it is easy to understand, but applying for this information to your personal situation without any further guidance could lead to a misunderstanding. And for that reason, we advise you that not to use this example as a direct application to your own circumstances. Instead, I encourage you to listen carefully, make some notes as we go through the webinar during the week. If at any point you have a questions or need a clarification, please feel free to use the chat function, as Gary and Carl will be more than happy to answer any questions itself. With that said, let's really get started. Retirement, how can we help? Well, in terms of first of all, what I want to do is share some of the important tips that would be really useful if you are thinking about retirement planning. Now, you might say that in the past, you might have taken the advice, the financial advice from an advisor for things like mortgages, investments, but retirement planning needs to be carefully planned with your individual needs and consideration. What we help you is to think about your retirement, what it might look like when you're your late 50s and 60s, and planning early for the kind of the retirement that you want will help you to make sure you're financially ready when the time comes. Now, you'll know where you stand financially, emotionally, and how that might change as you get closer to your retirements. And we'll cover those areas, including the drop of an income in your retirement, because it's a big change going from a salary just to a pension income, and how to kind of still cover your big expenses that'll come with the changes as well. So we'll guide you through in terms of your matching your spending with the expected retirement income, protecting your finances, and making some smart choices as you go through with it to secure a lifestyle that you always wanted in retirement itself. You learn in terms of how to prepare for the unexpected events as well. Things may not always go smoothly. You might have a plan where you might have something unexpected event can happen. So what we need to make sure that the financial plan is a really kind of a solid enough to handle those surprises, so you don't have to make some sudden changes and tough decision itself. And finally, the retirement planning isn't kind of a one-time thing. It's an ongoing process. We'll show you how to kind of adjust your plan as you move into your retirement and as your life changes itself. We'll support you in terms of making the right decision at the right time as you go along itself. Hopefully, by the end of this session, you'll have a clear plan of preparing for your retirement as well. But before we start looking at the retirement planning, let's have a closer look at some of the key areas that we are going to cover in the retirement planning session and address the common concerns that many of our clients have raised throughout over the years for us. Now, what we'll do first is we'll start discussing whether you have enough income in your retirement, explore the different sources of the income that you'll receive in your retirement, how to protect it, the strategies of spending it kind of carefully, and also the most important is the tax implication. Now, you may find that your financial situation is a lot better than you expected, and your retirement income doesn't need to be as high as your salary, because obviously you will have a certain outgoings that will be changed as well. So it's quite important to look into this as well and adjust your expectations when you're in your retirement as well. For those who are unsure about managing the capital in retirement, we'll cover and how to start using them. We'll also cover to protect this income for the benefit of your family, ensuring I'm referring to things like the money sitting into your bank and building society, tax-free lump sum from your pensions, investments if you hold stocks and shares and things like that, or even in some cases, inheritance if you receive that as well. So we'll discuss the strategies to preserve your capital value, protect it from inflation, and ensure that you have a growth so that your money could last you as much as in retirement as possible. You'll be surprised how much the retirement life could be, because in some cases we have seen it. We have got clients who've been retired a lot longer than what they worked during their life as well. And finally, the estate planning. Now, this is the where you will gain kind of an insight about creating a will, setting up the lasting of power of attorney, setting up like a legal framework to protect your assets. And this includes protecting in case of an illness or loss of a loved ones in terms of the partner, what happens in the case of the pension income drops and things like that. So we'll show you how to manage those assets according to your wishes, both while you're alive and also after you're gone as well. And we believe that by understanding the income, the capital, and estate planning, they all work together, and you'll be able to have a clearly a comprehensive financial plan that meets your retirement goals and needs itself. Now, why is it important? And this is a clear kind of things to remember, that we offer the support to all the clients from different ages. You have a different kind of a need. For somebody who's in 30s and just starting to kind of look at the planning for their financial future, to all the way to somebody who's in their 80s and 90s, clearly focused on managing the retirement and estate planning, passing on the wealth. So we help along throughout all those kind of the needs at different stages of the life. I must admit, we don't cover every life stage, but we do provide a good comprehensive help for many of the different financial situations. For example, again, if you're in your 30s and you want to build your career, savings by your first term, like at the mortgages, or protect your young family, will help you with that. For somebody who's in their 40s, their needs might be different. They are well set for it. And for them, the milestone is to kind of provide for their children's education. And for somebody who's approaching kind of a retirement into 50s and 60s, they want to know, obviously, that their retirement is going to be fulfilling, they will have enough income for it, and they wanted to make sure that capital lasts for it. So we have a variety of concerns at different stages of the life kind of thing. But the most important thing is to make your kind of the journey as smooth as possible, as much as informed as possible, and stress-free. I will take a time to understand your individual needs for it and work closely with you to create a plan so that you are able to have that retirement, whether they're being retirement or obviously any other financial goals that you have set yourself as well. In terms of giving the example, over the next few days, we'll explore the retirement planning in detail using the key example to explain the important concepts of the retirement planning. So now, I want to begin by introducing two teachers. First one is Ramesh on the left. He's a tapered member with the benefits in both the final salary scheme and the career average scheme. Most of you might be on this scheme, like a tapered member. A key part of his situation is the McLeod judgment, which affects the pension benefits for the period from 2015 to 2022. Now, Bob will explain briefly how this impacts Ramesh's service history later on. Next to Ramesh is David, a younger teacher, who is earning all his pension benefits from the career average scheme. Now, this is the pension scheme most of you are part of since April 2022. Or if you've joined and started teaching from 2015, you may only have the benefits in these schemes itself. This example will be particularly useful for those who are new to the profession with a service history in just these schemes. And we'll kind of carefully look at those two examples to explain to you how the pension benefits works in each of the pension scheme and how you can plan it effectively if you were, for example, David and want to get a sort of as much as benefits of Ramesh as well. So we'll explain that throughout the webinar as we go through. But the first one we'll have a look at is the income, the type of the different income you will receive in retirement. And I'm going to cover, to start with, it is a state pension. State pension, quite simply, a guaranteed income for the rest of the life, and it plays a very important part of your retirement plan that is often underestimated. Why I say that? Because I've seen it that some might view as a small benefit, or they say, well, it's quite further away, 67, 68, but actually can play a really big role in your overall financial picture. But before we look at what sort of amount you're going to receive it, let's look at when you're going to receive the state pensions. We have a table here on the left, which explains from your birthdays to help you figure out what your state pension age will be. Now, if you're unsure about it, you need more details, you can visit the gov.uk or use the online search, say state pension age checker, and they'll help you to tell you when you'll start receiving your state pension. But generally speaking, you're going to receive a state pension age, if you're lucky, from 65 or to 68, depending on your birth year as well. And if you are born after 1977, your state pension would be closer to 68. Now, as I was saying earlier, knowing when it will begin is crucial part of the planning of the retirement, because, as I said earlier, it's a guaranteed income that you are going to receive at a specific age, and that should be an important part of the overall financial plan. So when we're planning for retirement, whether you're intending to retire at age 55, 58, or 60, it is essential to kind of consider when your state pension will be, and that'll help you to kind of identify any potential gaps in your income before your state pension kind of kicks in. Now, understanding this will allow you to kind of adjust your plans for the savings and spending, helping you to kind of bridge the gap between your desired retirement age to when your state pension kicks in. So if you were to retire at the age 60, you know that you're going to potentially have a gap until your state pension age, let's say, was 67, so 7 years gap. So kind of know what the gap and the term and the income is itself, so you can make plans for it. So on that basis, I say the state pension is a key part of your retirement plan. It is always important to include in the retirement strategy to ensure that you have a clear picture of your overall finances when you retire and also when you reach the state pension age. Let's look at it, who's eligible for the state pension, and also understand the state pension entitlement. So the first thing, your state pension is based on your national insurance record. To qualify for the maximum state pension, you need up to 35 years of national insurance contribution, okay? If you have accumulated this 35 years, you're likely to receive the full amount. I'll go through the full amount on the next page as well. But on the other side, you need at least 10 years of the contribution to qualify for any state pension, okay? In terms of to qualify a full year of the national insurance credit, you need to usually earn approximately £6,500 a year. Now, some might say, well, actually, I earn a lot more than that anyway. That's based on the basic sort of income itself. But remember, we're talking about 35 years. So the start of the career, maybe the earnings was a little bit less. So it's important to know if you have any gaps because of that, especially things like if you're in full-time education or caring for children or base unemployment or an illness, then those things where the gap will exist, you still need to find out, because you might still be eligible for national insurance credits if those scenarios did occur. So always a good idea to check with the State Pension Service or Department of Work and Pension to see how these gaps affect your state pension itself. Now, if you have a missing year in terms of the national insurance record, fine. You can make a voluntary contribution, which is known as a Class 3 contribution, and to cover the gap. 1 year worth of a state pension entitlement to cover the gap, you will cost you about £923. However, I would say be careful that you don't end up paying the twice for the state pension credit. For example, if you are thinking about taking your teacher's pension at 55, 58, or 60, early retirement and you're receiving your teacher pension and you're still kind of short or have a gap in your national insurance credit, but you're intending to go back to work, either in a capacity in teaching or any other field itself, and your earning is more than £6,500, then remember, you are still building the national insurance credit. So what you don't want to do is find out that let's make the voluntary contribution of class 3, and you end up working, you ended up paying it twice because you're not going to get a credit twice for it as well. So careful with that planning as well. But quite simply, just make sure, check your national insurance record is complete, be strategic about it. If you're not going to return to work after you take your pension, and you still got a gap for it, then think about making the voluntary contribution to make for the full state pension. Why? I'll show you the next page, which will tell you what your state pension looks like. Now, the first thing is the state pension has evolved significantly over the past few decades. The state pension system starts with like a basic state pension, and then it moved on to state earnings related pension schemes. You might have heard the wording SERPs, and then the additional state pension, and finally to the new state pension introduced back in 2015. Currently, the basic state pension is worth £176.45 per week. So for those who have reached a state pension age after April 2016, the new state pension will be, you'll be entitled for that. And that is worth nearly £230.25 per week. Big difference. It's per week. So the amount you'll receive depends on which system applies to you. Now, one thing from the teaching profession, you got to be aware of it, that during certain periods, your teacher's pension scheme would have been contracted out of the state pension scheme, which means you were not contributing or counting towards the national insurance credit. So you were not being able to get the enough credit, which means your entitlement for your state pension will be a lot less. And this is not applicable for the teachers who have started after 2015, because for them, it's always contracted in, and you are making the full national insurance contribution as well. But if you have been teaching prior to 2015, which most of you probably would be, in that case, there is a likelihood that you may have a gap on the national insurance record, even though you were earning more than £6,500, because your teacher's pension scheme was contracted out. So look out for that as well. Go on to state pension, use the government online service to identify, ask for them the statement to be provided, and then obviously you can discuss the next stage whether you wanted to make up that contribution or not. The other thing is about this tax. The state pension is paid out as gross, okay, which means it is not taxed at the time of the payment that is made, but it is a taxable income. And the reason why you got to be careful about it is because in terms of the tax allowance, everyone is entitled to receive a personal tax allowance of £12,570. And that is applicable to all types of the incomes, including the state pension. So in short, basically, you're able to earn up to 12,570 without paying any income tax. And once you start earning about that, so if it was a combination of your state pension and teacher's pension, then obviously your teacher pension is likely going to be taxed fully before your state pension. Yes, because state pension uses most of your personal tax allowance as well. But one of the other benefit of having the state pension is also, you might have heard the phrase triple lock system. What is a triple lock? It's effectively a guaranteed annual increase based on the highest of the three factors: national average earnings, 2.5%, or consumer price index, CPI. Why this is important? For instance, back in April 2024, the state pension increased by 8.5%. Now, I know that not a lot of people might not have received that sort of a pay rise, but state pension did increase by 8.5% because it used the CPI rate of the previous September. So in September 2023, obviously 22, 23, we had a higher inflation. So it uses that figure to increase your state pension as well. So does your teacher pension increase in that line as well? Bob will explain that a little bit later. But got to be careful with this one, because while the triple lock has a significant benefits, the government is always looking into it because of the rising cost to maintain that and also the longer life expectancy. So important to kind of stay informed with any potential changes, if any, is being made by the government. In all short, basically, understand your state pension structure, check your entitlement, and knowing what and how much you will receive will help you to make the retirement planning somewhat easier. You can defer your state pension. You can defer it. It's an option that is worth considering, but it might not suit everyone. Why I say that? But before I explain, then deferring is mean that you are delaying the receipt of your state pension beyond your state pension age. As I say, the choice is not common, but it can be beneficial in certain situations. For example, if you were to continue to work past your state pension age and you're receiving your pension income and your salary, that's putting you into a higher rate tax bracket of 40%, then deferring your state pension age could help you to avoid paying a higher rate tax pay. By deferring the income, say, for example, if you were to delay the income, you are going to stay into a lower tax band, which can minimize the amount you can pay on your overall income. So worth considering, not always, like I said, a common thing, but I have seen the clients which have used it as well. Now, if you do defer a state pension, it increases the value by 5.8% for each full year of deferral. So it's offering you kind of a guaranteed return on your pension income. But keep in mind that by deferring, you're giving up 1 year's worth of a guaranteed income. And also, if you pass away, the deferred state pension is not inherited by your partner. Okay. Now, this is a significant consideration. As the pension stops with you, state pension dies with you. So while the deferral can be beneficial in specific circumstances, it is not commonly recommended for everyone. Ultimately, deciding whether to defer the state pension should be based on your individual financial situation and long-term goals as well. So before I wrap up this section, what I want to do is just kind of remind is to kind of verify your state pension age. Request a state pension statement as well, as if you haven't done so already, because this step will help you to kind of look at the retirement plan alongside the teacher's pension or any other pension you may have it. And by understanding what your state pension is going to be, when you will start, how much you can make up for it while you haven't reached this state pension age, you will be kind of better prepared for your financial future. I hope this has kind of provided you with a good overview and kind of set the stage for what's to come. I'm going to hand over to Bob, who will continue with the next part of the discussion. Bob?
Thank you very much, Akbar, and good evening, everyone. My name is Bob Wells. I'm one of Akbar's colleagues, financial advisor at BBT, and it's my pleasure to take you through and hopefully demystify the teacher's pension element of your retirement income. We'll look at the teacher's pension at the normal pension age, as early retirement will be covered in tomorrow's session, module 2. But tonight I'll look at the various iterations of the teacher's pension, particularly the final salary element and, of course, the career average. As we go through it, there'll be some tips and tricks and techniques that we'll discover as we go. So here we are. So the teacher's pension is a first-class pension. Whether I know there have been changes, I'll talk about those in a moment, but whichever version or iteration of the teacher's pension you're in, it's a first-class pension. I'm a financial advisor. I look at pensions of all different kinds and complexions in my everyday work. But I have been a teacher and for about 12 years, and I've got a teacher's pension. My wife's a teacher, she's got one, and we are delighted to have them. So it is a very good pension. Just want to make that really clear at the outset. There are 4 key elements to the teacher's pension. The first of those, perhaps most important, particularly in respect of tonight's discussion, is the pension income that it will generate for you. It will be paid from when you retire until you die, and it is visible on the statement. I'll show you a statement so you can identify where this is shown. The second element is that you everybody is entitled to a tax-free lump sum from their pension savings. Some of the people watching tonight will have final salary schemes, and you will have guaranteed or a standard lump sum. But even if you're in the career average, you'll also be able to take a lump sum from your pension. I'll talk about that in more detail in a moment. Thirdly, family benefits. Well, that refers to the pension that will accrue to your spouse or your partner, and possibly even dependent children if you were to pass away either now while you're in service or during retirement. I'll go through that in a bit more detail as well, but a very, very valuable benefit. And fourthly, the death grant, which is quite often and commonly termed as the death in service payment. And this is a lump sum that will be payable to whomever you nominate if you were to die while you're still employed as a teacher, while you're still in service. It works out at 3 times your reference point salary. And it's important to note that it doesn't have to accrue to a spouse. You can nominate whomever you like to receive the death grant. It's a very important, so there'll be some tips and techniques to think about. It's very important to check your teacher's pension account to make sure that your nominations to the person that you'd like to leave this death grant to are up to date. We've had situations in the past, we've come across clients where they've actually been divorced and their former spouse has been listed as the beneficiary of that death grant. So that wasn't suitable for their needs at the time, so it's something that was important to address. So simple thing to do, doesn't take very long, but do check that those nominations are up to date. What I've got here on the screen for you is an example of the teacher's pension statement, or part of it, I should say. And this shows the first element, the amount of income that your pension will provide, or this teacher's pension will provide for them at normal pension age. Doesn't take into account early retirement, this headline figure. This also shows that this teacher is in the final salary scheme and will have an automatic lump sum, and the figure is given here. A little bit further down that opening page of the statement, you'll see that the total death grant, this is the death in service payment that this person or their beneficiaries would, or their nominated person would receive if they were to die while they were still employed as a teacher. And the total annual family benefit for this person, it equates to about half of the pension income. So that is the income that will be paid if you were married to your spouse for the rest of their life. I say spouse, but it can also accrue to unmarried partners. There are some conditions to that, there are some differences if you're an unmarried partner to what you'd receive. And I did mention that potentially dependent children as well could benefit from that until they're no longer dependent. There are very specific circumstances on when that would apply. So that's a little insight into what the teacher's pension statement looks like. It's changed recently. So if you've got a statement from a few months back, it looks different. It is a different version, different format now. So that's the latest. Now, it's really important to understand where you sit within the teacher's pension scheme and which parts of it apply to you. It's been reiterated over recent years. The original final salary scheme, the MPA 60 retirement at 60 scheme, arguably the best of the three, and there have been 2 further iterations since. So if you joined teaching before 2007, all of your service will be in the final salary scheme. It has an accrual rate of 1/80th, so 1/80th of your final salary multiplied by the number of years. I'll go over that in a minute anyway. And you'll get an automatic tax-free lump sum 3 times your annual pension. If you join teaching between 2007 and 2015, you'll be in a final salary scheme, but one without an automatic lump sum. It also has a later retirement age. The normal pension age for that scheme is 65. All the service until the 31st of March 2022 will be in the final salary, and it has an accrual rate, slightly more favourable accrual rate of 1/60th, and that's because it does not have that automatic tax-free lump sum. You can get a lump sum, it's worth pointing out, but you need to exchange income for that lump sum. Again, please don't worry about that now. I will go through that shortly. And then the final iteration, the most recent one, is the career average scheme, which has a normal pension age of your state pension age. And this applies to those that joined teaching after April 2015. So any new teachers will be exclusively in this scheme. It's not a final salary based, it's based upon an average that accrues over your career. I'll go through that, don't worry. Has a more favourable accrual rate. But again, no automatic tax-free lump sums. Now, the majority of people watching the webinar tonight will be in a combination of both of these, the 60 and the career average, or the 65 and the career average. So there'll be a blend. So I'll break it down. I'll go through them in turn, but it's worth bearing in mind. And as Akbar pointed out earlier, this is a situation that's exemplified by Ramesh, his situation, a hypothetical example that we'll use. Now, when the transition from final salary to career average occurred, was originally arranged when the changes were first conceived on the basis of age. So it depended how old you were as to when you would transition across to career average. That proved to be problematic. Members of the judiciary pension scheme and I believe the fire service pension scheme took the government to court on the basis that the transition arrangements were ageist. Long and short of it is that they won, and the government had to rethink the way that that transition was applied. In the end, they came up with a solution which meant that everybody, regardless of age, transitioned from the final salary pension that they were in, whether it's 60 or 65, to career average on the 31st of March 2022. So far, so good. However, some people, not a huge number, will actually be better off under the original ageist transition arrangements. So you will actually be given a choice at the point that you retire as to whether you take the pension as it was under the original transition arrangements, or whether you take the pension that's available to you under the revised post-McLeod transition arrangements. It's not something that you need to worry about immediately. It depends when you're retiring, I suppose, but it's something that you decide upon at the point that you retire. Now, the TPS have been busy providing information to teachers, and I'll show you on the next slide an example of a statement which shows this particular teacher what their options are. So if they were to use option 1, that would mean that the bulk of their pension up to the 31st of March 22 would be in the final salary scheme. And if they were to have chosen the earlier pre-McLeod transition arrangements, what their situation would look like. So it gives clear information. So this will be provided to you. There are clearly differences in terms of the income available, and clearly differences in this case with the lump sum, automatic lump sum that would be available. So it's something that you don't need to decide about now. It's probably a very good idea to get independent financial advice about that when you do have to make that decision, because clearly this can impact considerably. Getting this decision right is important. So just to make you aware that information will be made available to you, which will help you make that decision. But get advice, I strongly recommend that. So let's look at the final salary 60 scheme first of all. Now, as I mentioned just now, it has a normal retirement of 60 years. It's based upon the length of time that you've been involved as a teacher, have been part of the teacher's pension scheme, years and days. Now, it's really important to check that on your statement, all the career history and all the contributions into the pension scheme are listed. And I've had several clients myself, and I know as a company we've had many clients who found errors with that service history. Again, don't worry about it, but it's something to get on top of and make sure is correct at an early opportunity. I would leave this, you'll deal with it years rather than weeks and months before retirement. In all cases, people have had the errors rectified. It means a bit of admin on your part, chasing up admin departments, yeah, possibly even the local authority and liaising with the TPS. But in all cases that I've come across, that's been satisfactorily sorted out. Clearly, final salary is based upon the last year's salary or the best 3 years, best 3 consecutive years in the last 10 that you're employed, and inflation adjusted for that. So if the final year that you work is absolutely the best income that you've had throughout your teaching career, it'll be based on your last year's salary, or some people do taper off a little bit as they approach retirement. If your best 3 years are in the last 10, they'll be used instead. And again, you don't need to worry about that. The teacher's pension are very fair. They want you to get the best pension you can, and they actually show you on your statement which of those two they've used, and they'll always use the better of the two. So nothing to get too worried about, but it shows there is a bit of protection for those whose income drops a little bit towards the end of their retirement. There's also this idea that if you have a 10% or greater pay rise in your, say, final year, it's a little protection against manipulation of the scheme. Now, I appreciate most people aren't in a position where they can do that, but it's built in. So if you have a pay rise of greater than 10% in your final year, anything over that 10% won't count towards your final salary. There's a little protection for the scheme built into the scheme. So how's it calculated here? This slide helps us work out how a hypothetical example of a teacher's salary could be calculated, a teacher's pension under this scheme could be calculated. So you get 1/80th of your final salary as a pension for each year that you work, and you'll get 3/80ths as a lump sum, tax-free lump sum automatically. So if we got a teacher with 35 years service and they had an average final salary, best 3 years in the last 10, say, of 68,000, it'll be 35 number of years worked, divided by the 80th, multiplied by 1/80th, multiplied by 68,000, that salary. So that gives this hypothetical teacher a taxable pension income of 29,750 at normal pension age, which would be 60 in this case. They'll also be entitled to that lump sum, which is 3 times that pension income, and that is tax-free. That's how it's calculated. However, there is an option for people in the 60 scheme to increase that automatic lump sum to a maximum. Now, everybody's entitled to 25% of their pension savings as a tax-free pension commencement lump sum. It's very difficult with a teacher's pension to calculate what 25% is. It's possible. There are some mathematicians called actuaries who work this out. Don't worry about the calculation or the formula for doing that. Teacher's pension show you this on the statement. And it's difficult to calculate what 25% of a teacher's pension is because it's an income stream that's going to carry on through your life until you die, and also some of it will go to a spouse or partner, as opposed to a normal personal pension, which is actually a valued pot of money. 25% of a value is really easy to calculate. 25% of an income stream is tricky, but they do it. So in this case, the original standard automatic lump sum was 89,250. The maximum available to our hypothetical teacher is 159,374, and that's tax-free cash. So they can increase that lump sum by 70,124, significant increase. But you've got to exchange income for that extra lump sum. So there's a bit of a trade-off. That's calculated in this way. So for every £12 of extra lump sum that you choose to take, and by the way, I should just mention on that previous slide, it's not a minimum maximum decision for you. You'll actually be able to choose increments between the two. Okay, so it's not an all or nothing. Again, it's something that would be a good idea to get financial advice over to make sure that you're making the best decisions. You get one chance, you want to get it right. You can't change this after you've made the decision. So for 12, every £12 extra in lump sum, the pension income is reduced by £1. So it's an exchange, exchanging income for lump sum. So in this case, the additional lump sum available to the maximum was 70,124. Divide that by 12, shows the amount that the income would need to reduce by in order to get that. So the original pension was 29,750 minus this commutation, this exchange of 5,844 per annum, would leave a residual pension of 23,906. So you've exchanged taxable income for a tax-free lump sum alternative. And again, it can be flexible. I'm talking about maximums here, but you can tailor this to your needs and make a decision at the time you apply for your pension benefits. So that was the final salary. That was the 60 scheme. So I'm going to look at the other end of that little table where we had the three versions there. Career average. So your normal retirement age, clearly very different. It's your state pension age. So not 60, 67, 68 we're talking about here. So it means more work before you get to the amount that's shown on your statement. Again, it's based on your length of reckonable service, years and days. And again, the same argument about checking the service history applies. By the way, strike days don't count, but everything else pretty much does. And it's not based on your final salary or the best three in the last 10. It's actually, you accrue a bit of pension each year that you work. And it's based upon, this is how it averages out. It's based upon your income at each year. It's based upon your income each year. So I'll flesh that out a little bit more, but again, revalued for inflation, so it's inflation protected. So let's use an example here. So we got a teacher who in their first, let's say their first year of teaching here, April 24 to 31st of March 25, they earned 40,000. The accrual rate in the career average is 1/57th. So 40,000 multiplied by 1/57th means that they've got, after that first year's work, are going to have at state pension age £701.75 per year for the rest of their life in pension income. So that's banked essentially after year one. Second year teaching, a little bit of a pay rise, 41,000 in the following year to 31st of March 26. They're going to accrue or bank a bit more pension income. So this time 41,000 times the 1/57th is 719.30. So after 2 years, quick mental maths here, after 2 years, they're going to have built up a pension income of £1,421.05. So you can see how that could build up through a career, and it averages your salary and how it relates to the pension over your working lifetime. No automatic lump sum, remember, on the career average, but you still can commute or exchange income for a lump sum. And I'll show you how that works. So hypothetical teacher who's always been in the career average, 29,700, no automatic lump sum, but we're all of us, every British subject is entitled to 25% tax-free lump sum. So the maximum lump sum available to this person is 127,499, which is tax-free. But they would see their pension reduced from 29,750 to 19,125 taxable income. So again, it's a 12th. So it's one for every £12 of lump sum that you take, your pension's reduced by £1. So your original career average pension of 29,750, if they took the 25% tax-free cash, the maximum, they would see their pension reduced to 19,125. Okay, so it is possible for career average to exchange income for a lump sum. So what we've got to bear in mind is that it might seem at first that you're giving up quite a lot for that lump sum, but there's a big difference between income, which is taxed, and lump sums, which are not taxed. So in that example, the career average teacher gave up 10,625 worth of income for that lump sum. But actually, because it's not, the lump sum's not taxed, they've actually really only given up 8,000, I say only, they've given up 8,500 of net income for that. So that gives us an opportunity to calculate how long that lump sum would need to last before you were better off for not having taken that lump sum. And broadly speaking, it works out around about 15 years. So if you retired at 60, took the maximum tax-free cash, it'd take you 15 years before you were better off having not done it, if that makes sense. So you're better off 15 years. So you've got short life expectancy, for example. It might be better to take that tax-free cash. You don't think you're going to last 15 years, so 60 to 75, might be worth taking that tax-free cash. Also has a benefit in that most of us are going to be more active early in retirement than we are in later retirement. Big difference between 60 and 70 and 80 and 90 when it comes to activity. So it gives you the opportunity potentially to front load your retirement. I'll come back to this in a minute, but key thing here is that beware that to get tax-free cash, you're giving up actually a lower amount of real terms income than you might first imagine. The reason I'm showing you this is, again, it's another excerpt from a real life teacher's pension statement, because I think it's useful that, you know, what I've just told you might be quite challenging to take on board straight away. But the good news is that this information is provided for you on the teacher's pension statement. So in the final salary element here for this teacher, their annual pension would be 17,683.12 with an automatic lump sum of 53,049.35. It's a standard bit there. But they've got the option of increasing that lump sum by a further 680.97, and they would, the TPS has already provided the lower, how much the annual pension would be reduced to should they opt to do that. So this information is available. So what seems like complicated calculations are there and available to you. It also shows here that, you know, I was saying they choose the best method for you. That's given on the statement as well. For the career average, the career average element, annual pension given, you know, if you weren't to take a lump sum, remember there isn't an automatic lump sum with the career average, it's just an income, unless you choose to take the lump sum. In this case, they could choose to take an additional or 60,850.62 tax-free cash lump sum, but the pension income would drop from 14,198.58 to 9,127.70. So hopefully that helps you, or helps reassure you that that information is going to be readily available to you. But Akbar, myself, and the other advisors are always very happy to go through this with you if you do want to, given your personal circumstances. So who should consider commutation? Well, a few of these kind of group together. So if you're likely to be a higher rate taxpayer in retirement, having tax-free cash clearly makes the loss of income through that exchange even less painful. You know, you're not going to pay income on that, so it gives you a longer break even. If you're going to have a short life expectancy, it might be better to take that money up front. If you're not going to get to the break even point, which in our example was 15 years, and don't think you're going to last that long, it might be worth thinking about taking that that cash tax free. If your spouse or partner's position is strong in terms of income, they might be able to provide most of the income required for retirement. Again, it might be better to take that money as tax-free cash and save the tax that would otherwise have been paid on the income. So you don't need the income in this case, and potentially this case, it might be better to have tax-free cash, more tax efficient. And these two are pretty much linked. If you've got a significant surplus of income over your lifestyle expenditure, again, why take income you don't need when it's taxed? Take a lump sum in its place. But the default starting point on all of this is that we should really consider taking the maximum income unless there's a good, strong argument that we should take the tax-free cash. If it's going to be touch and go whether you're going to meet your lifestyle expenditure from the maximum income, you should take the maximum income. Clearly, it's a lifestyle decision. And again, good advice here will really help you. Some cash flow modeling, thinking forward will help you make the right decision. If you're single and you don't have any dependents, you might want to just enjoy that early part of retirement. Like I said, front load the retirement. And in fact, all of these front loading the retirement might be a consideration. Do more while you can. But you might, if you haven't got any dependents, you might want to, move that lump sum onto charity or use it yourself. So there are different circumstances where that decision could be questioned, but I should really say that the default position should be maximum income. This is a good argument otherwise. Your monthly pension that you'll receive from the CPS is paid the day before your birthday. This is how they spread it out through the month. So if you're born on the 5th of January, you'll be paid on the 4th of each month. 15th, like I am, you get it on the 14th. So it's feasible if you've got a birthday early in the month that you'll get quite a small pension in that first month of retirement. But worry not, because if, like lots of people, you retire in July, do the summer holidays and actually finish work on the 31st of August, you're going to get the August money through the September, which sort of cushions the blow here, and then you'll get your full pension from October. So that's how when you can expect it, and that's how they spread the payments out and the admin. The lump sum, we'd say expecting the first 1 to 2 weeks. So if you did that retiring in August, take your pension in September, you could expect in the first couple of weeks of September. However, we do actually find it's a bit quicker than that. They're pretty prompt. You generally get that very early in September. And if you are one of those people with an early birthday, they may well lump the two together, lump sum and that little bit of pension that you've accrued through the first couple of days of September. We use that example. So hopefully it gives a bit of clarity onto when you can expect these things. But it's important we just look at, because as I mentioned at the beginning, a lot of the people watching this, like myself, are blended members. So they have a foot in both or two camps. They might have a foot in the final salary scheme, they have a foot in the career average. Ramesh is our example. So on the final salary element, let's say he wants to retire at 60, he can take that pension fully at 60, that final salary element. Let's say he's got 25 years of service in the scheme and he had the final salary of 68,000. He can expect an annual pension of 21,250, and he will receive an automatic lump sum of 63,750. He will also have a bit of career average, and the two come together. They're combined for his final, for his actual pension income. Now, the career average scheme for someone of Ramesh's age would have a normal pension age of 67. He's got 10 years of service in the career average scheme in this example. He had a starting salary of 45,000 and he finished on that 68. So having done the maths on this, he can expect to get an annual pension of 9,750 per annum from that. But there's no automatic lump sum here. So we'll assume that Ramesh just takes the automatic lump sums, doesn't commute income for lump sums. But it's important to note here that he is actually retiring early from this scheme. So if he does actually retire at 60, he's left this scheme 7 years early. So that figure, that 9,750, has had the actuarial adjustment applied to it. So that's early retirement applied. That's covered tomorrow in detail, but a lot of people think about taking early retirement as a bit of penalty. Actually, you're taking an income for a longer period of time. So actually, you find that you're not that much compromised by the two figures work out. Again, it's covered in tomorrow's webinar. So if you're interested in early retirement, do tune in tomorrow. But I just wanted to point out that that figure there does allow for the fact that he's going to retire early. So when you bring the two together, his final salary pension, 21,250, is added to the career average pension, 9,750, which has been applied the early retirement factor. So his total pension income, very healthy, 31,000. And he's also got that automatic lump sum, 63,750. That's how it works out for somebody who's blended. So the two pension amounts, final salary and the career average, added together. A lot of people misunderstand that. David, he's got all his career history or service history in the career average. He also wants to retire at 60. But the career average, as we noticed, was Ramesh got a retirement age 67. He's accrued 35 years of service. His salary started at 25, ended up at 68. Very similar, the same as Ramesh. But he can expect to receive an annual pension of 29,230, and that again is a figure that has the early retirement factors applied to it, but he receives no automatic lump sum. Critical difference. His scheme is set up for him to retire later. He's got to take a bigger hit on the early retirement, and there is no automatic lump sum. So when we bring them together, so we can compare the difference between somebody who's in the career average, someone who's in the sort of blended arrangement. Ramesh is going to get an income of 31,000. David's not far off, actually. His income is, broadly speaking, comparable. This is the annual income. The big difference, as you can clearly see, is that David benefits from no automatic lump sum. Now, if you are in David's situation, your career average, or the bulk of your pension savings are in the career average, don't worry. The following webinars, particularly module 3, will help explain how people like David can get on top of that situation and put themselves in a position that's comparable to Ramesh. I mean, it's costly, you've got to work on it, but you can get yourself into a comparable situation. So tonight, Akbar and I have covered the first of the 3 pillars of the effective financial plan income. As mentioned, capital is going to be covered on Wednesday, early retirement tomorrow, and estate planning on Thursday. Estate planning, wills, lasting powers of attorney, protecting what you've got and making sure it goes in the right direction if and when you die. So if you get all of those together, it does require you to watch the rest of the webinars. We've covered the first of them tonight, and hopefully you found that useful. So firstly, thank you, Akbar, Gary, and Carl for being here tonight and helping everyone understand their pensions in a bit more detail. And thank you very much for tuning in. I hope that you found it helpful. I have overrun ever so slightly, but hopefully, the extra detail has been beneficial. So thank you for listening. Please do carry on and listen to the rest of the modules. They all come together to give you a very strong starting point from which to plan your retirement. When you leave the webinar this evening, there's a short survey. We do this for you, and we're very interested in making sure that we tailor these webinars to your needs. So we really do take the feedback seriously, and we welcome it. So please do leave some information or your comments and views on the survey. But also you'll be given the opportunity to book a consultation. As Akbar rightly mentioned at the start, this is generic information, and hopefully what I've shown you tonight has evidenced the need to get financial advice if you want to get yourself off to the best possible start in retirement, and make sure it's a success throughout. So please do take the opportunity to book a consultation. So thank you very much again for listening. I'm going to close the webinar down now and look forward to seeing you again soon. Thanks very much. Bye now.